Okay. Thanks, Alvin, and also thanks everyone's patience. For me to resetting up my computer. Let me jump straight to the topic tonight. Basically, tomorrow will be the day when we announce the all-important list for the seventh standing member of the Politburo of China. So that is probably one of the biggest events in Chinese modern history. Because right now we're selecting a leader for probably for the next decade and more. So who's in, who's out, who's doing what is going to be a key decision for the next decade. And obviously, the market is very nervous for the past week, for this week, and also for the past week. Even though the Hong Kong market is extremely oversold, we're not seeing a lot of buying from the market. Basically, the trading volume has shrunk dramatically. But then at the same time, we're seeing long fund liquidating the position in China. 2 days ago, there was a fund dumping $500 million worth of Chinese ADRs on market in the day. So that caused tremendous pain in the Chinese space, especially in the Chinese ADRs. So obviously, besides what's going on in China, the dynamics between China and the US is also playing an increasingly important role to determine where the market is heading. And obviously, right now, the market doesn't have too much confidence in the direction going forward. But let me go through some key economic variables that we look at. And these are the variables, or these are the less discussed relationship in the marketplace. And I believe that maybe not all of these relationships have been priced in the market price. So firstly, let's look at the US inflation situation. And the outlook of US inflation would determine where the Fed's monetary policy is going to be for the coming quarters. Basically, we're looking at some leading indicators such as the NFIB job hard to find, job hard to fill index, and obviously the blue line, which is the job hard to find index, hard to fill index. The lower the index is, the easier to fill a job. All right, so, and normally this blue line, the job hard to fill index, tend to lead the CPI by about 6 months. All right, so we're seeing a dramatic decrease in difficulty of people finding a suitable applicants for the job. And if we are seeing a collapse in the difficulties in looking for applicants, therefore, then in the coming quarters, if historical relationship continues to hold, then we should see the US CPI coming down as well. And I believe that, this is why, beyond the immediate 2 quarters, we're seeing the US Treasury futures increasingly pricing in a Fed pivot. But then at the same time, we wouldn't be jumping for joy if that happened. If that happened, if inflation does collapse, it actually means that the demand in the US collapses as well, and it has a tremendous implication for China. Now, as you can see, this year, what is holding the Chinese economy up is exports, right? So exports has been going from strength to strength for the past 2 years. It's actually one of the few shining spots remaining in the Chinese economy. All right, so this year, even though year-on-year Chinese export growth has been slowing down, it is still growing at about 8 to 10% per month, and also it's translating into huge trade surplus for China. So just imagine, right? So if the U.S. demand slows down, therefore the demand, which China is a major supplier of U.S. demand, is also slowing down. So Chinese exports consequently will slow down as well. So therefore, as you can see, then the Chinese economy would be in a pretty difficult situation. Right. So one shouldn't be too surprised to see that happen. All right, in the coming 2 quarters. So when that happened, right? So just imagine China doesn't have the export leg to support its economy. Property sector is still ailing. The fiscal expenditure is being limited by government debt and also by local governments' huge physical deficit, because they couldn't have enough land sales proceeds this year to refill the budget deficit. Just to imagine what that happened. Right. So then, and also, another key issues that is in people's mind is the COVID-0 situation. A lot of people were hoping that, after the 20th Congress, we will relax the COVID-0 policy. Now, unfortunately, that didn't happen. All right. So I think, people have a sort of a misplaced belief in how the Chinese culture approach, problems such as this, right? So because the senior population in China, it is still 60%, around 60% vaccinated. So, if there are some unforeseen uncertainties about this virus, then it will make the senior population in China very vulnerable. Right? So obviously the Chinese leaders won't let that happen. So as a result, China tend to approach critical issues with a gradualism. Right? So we wouldn't, switch the on and off switch overnight, but gradually. We should adopt a gradual approach and also gradually open up the Chinese space. And so therefore, the most likely time to be sort of moving towards that direction is probably after March next year, in 2023, when the twin sessions finished in March. So then that way, the reopening is later than what most people were believing. But is that a really bad thing? So a lot of people seems to think that, COVID-0 has impacted the Chinese economy in a huge way. I sort of cannot completely agree with that opinion. Basically, one has to reconcile between very strong Chinese export and also very restrictive COVID-0 policy. If COVID-0 policy is limiting the production capacity, then, who is producing all the exports? Who is supplying the US demand with all the exports? Right, so it just doesn't add up. And also there's a reason, besides the reason of protecting the senior population, there's another reason why China wants to sort of adopt a restrictive COVID-0 policy and also, adopt a gradual approach towards reopening. Now, because, manufacturing and also exports is, one of the bright spots remaining for the Chinese economy. I mean, just imagine when you reopen the entire economy and then the virus have unexpected consequence and then started to affect your manufacturing base and start to impair your manufacturing facilities and capacities. Then that way, really, then it will make the Chinese economy even more difficult than it is right now. All right. So this is probably one of the strongest reason that I can think of to stick to the COVID-0 policy for now. But in recent days, though, there are some early signs of relaxing the COVID-0 policy. For example, I'm sure you've heard of the discussion about 2+5 instead of 7+3 quarantine for foreigners coming into China. And also, the Chinese airlines are reopening the international routes with some Asian countries. But just, keep in mind that even so, the reopening flight capacity is about 5% of 2019, right? So it's very small, but we will say it is the one sort of a step towards the right direction. And because of that, right? So because of the diverging Chinese and U.S. Monetary policy, undoubtedly it's putting a lot of pressure on the Chinese yuan, right? But having said that, the Chinese yuan is still one of the best performing emerging market currency against the US dollar. I mean, even if you consider the euro, the pound, the yen, the Chinese yuan this year is actually depreciated far less than many of its trading partners. So if you look at how the yuan sort of moved over the past 20 years, you can see that it has a very close correlation with forex reserve and forex deposits in Chinese commercial banking system, right? So the yellow line. So you can see almost like a one-to-one correlation between these two variables. Now, the funny thing this year, if you think about it, right, the funny thing this year is that the exports has been going from strength to strength, but the Chinese yuan is still depreciated. Right, so it is very strange, but this chart sort of explains to you why that happened. Basically, even though the Chinese yuan, the exports has been going very strong, but foreign reserve and also forex deposits in the banking system didn't increase much, and on a year-on-year basis, it's actually decreasing. It's very, very odd. And so because of that, and also because of the divergence between the Chinese and US monetary policy, it's putting undue pressure on the Chinese yuan. So another way to look at it, is, trying to see, or another potential variables that we should look out for, to determine where the Chinese market is going, is by looking at the Chinese shadow currency exchange rate. So basically, we can simply use Chinese M2, which is about 250 trillion yuan, divided by the forex reserve, which is about by today's exchange rate, it's about 30 trillion yuan. All right, so 250 divided by 30 is about 8. Okay, so 8 to 1 US dollars. So as you can see, over the past almost 30 years now, the shadow currency exchange rate goes almost hand in hand with the US dollar index. So by now, by the simple calculation I offered just now, right? So 250 trillion M2 divided by 30 trillion forex reserve, you get a ratio of 8, and now the Chinese yuan is about 7.3. So theoretically, you could see the Chinese yuan, breaking out to 7.8 or even 8 and above. So that is a theoretical variation of the Chinese yuan. But having said that, you can see that on this chart, it almost never happened, right? So since 2001, China entered the WTO till now, the shadow currency exchange rate never really go beyond 8 that much, right? So I think the highest that we have ever went to is about 8.2. So right now we're at about 7.3. So to me, the pressure is still on, and I think the PBOC will try very hard to defend the currency. And also weaker currency is actually helping the Chinese exporters, right? So even this year, export growth slowed down. They're still making heaps of money because almost all Chinese exports are priced in US dollars. Right. Another way to look at it is to look at the yuan's valuation cycle. If we put on a 3.5-year moving average on the Chinese yuan currency movements, and you can see that, right? So at every time at the intersection where the Chinese yuan cross this moving average, something very important happened, right? So if you look at, for example, 1990, you have the economic hardship, right? So that is after after the period of very high inflation. So then there is a one-off jump in the yuan depreciation back in the 1990. And then in 1993, there's a currency reform. So in one step, the Chinese yuan depreciated from 5.5 to 8. Okay, this is huge. And then 2005, there's a currency reform again, and that is for the yuan to appreciate. And then it goes all the way to 2015, another Chinese currency reform, and that went from 6 to 7 to 7.3, blah. So it is a very interesting chart. The cyclical feature of the Chinese yuan is very vivid on this chart. And right now, because once again we crossed this cyclical line, the moving average. And therefore, to me, potentially the yuan can depreciate much further from here. It really depends on how the PBOC is going to manage it, to manage the yuan currency depreciation. But in recent days, the depreciation pressure has intensified. So another very important issue from the 20th Congress is about the Chinese property. Many must have read the news stories about how housing is for living in, not for speculation, is actually not mentioned during the speech of President Xi. But this term is actually still written in the draft of the speech. So there are a lot of guesses, why this had happened. Many people were saying that, maybe the housing is not for living in, is not emphasized anymore. But to me, it reflects that there's a huge debate going on in the party, and he has a point, right? Because the property price is very expensive in China. So, then that way, in order to compromise, right? So we write it into our speech, but we don't mention it during our speech, right? So that is a nice way to reach a compromised agreement between, the other section within the party. So as you can see, since 2019, the relationship between Chinese property and also the overall Chinese stock market has changed to an inverse correlation. Now, before 2019, basically, whenever the Chinese property did well, then it means that the stock market tend to do well as well, right? But not until 2019, the relationship between stocks and property flipped. And also in 2021, China proposed a 3 red line policy, so limit how much loan the commercial banking industry can lend to property developers. It limits how property developers can use leverage to buy land, and also limit the leverage that property developers can have on their balance sheet. It was huge. So ever since then, you can see a very prominent inverse correlation between these two variables. So by now, if people think that China is trying to rescue its property sector, then it actually doesn't translate into a very strong stock market. So let's look at how the market is trading right now. So this would be the last few charts that I'll be sharing with you tonight due to time limitation. Now, firstly, let's look at how oversold the Hong Kong market is right now. So the yellow line is, the number, the members, the number of constituents of the Hang Seng Index that is above 200-day moving average. So right now it's actually one of the lowest in the past 20 years. So it's as low as 2020 during the COVID. It is almost as low as 2016 after the Chinese bubble burst, and also almost as low as 2008 as well. So pretty soon, you will see all the index member below 2,000-day moving average, 200-day moving average. And also in terms of China CDS spread is on the rise as well. I think it's a reflection of a weaker currency and also a reflection of the US dollar strength. But as you can see, even though the CDS spread is surging, it is still not as high as when it was in 2015 and also in 2011. When there was the US credit rate, a sovereign credit rating downgrade. So potentially it can go much further from here, given the situation that we're facing, and also the top down PE, which is the dotted blue line, it is very low. It is very, very cheap, but it's not the cheapest in history. So it can go lower from here. Last chart, is the offshore Chinese US dollar high yield bond. Right? So as you can see, there's a huge collapse going on there. In recent days, many of the names, not just the property names, many of the Chinese tech names, right? So Tencent, Alibaba, they all have long-term outstanding bonds, right? So many of these bonds is being sold down aggressively as well. So from peak to now, many of these bonds are down almost 50%. High yield US dollar bond is being sold. The Hang Seng valuation is very cheap, and the currency is also has further room to depreciate as well. So I'm sure that everyone is waiting to see what tomorrow's list will bring, and let us hope that once that uncertainty settles, the market can refocus on fundamentals and move forward. I'll stop here and hand back to Alvin.